All right. Hey guys, different place today. This is RC Peck with Fearless Wealth. And so the first thing of most important is to introduce you to the newest member of my family. And so, sweetie, will you give me the newest member? Oh, look at who this is right here. This is Scotchy right here. And Scotchy is 8 weeks today. And he's about 8 pounds. And he is just an absolute sweet love. We haven't even had him a whole week, and I don't know what he's eating right now. What is in your mouth?
He's eating this.
Oh, he's eating the plant. So I want to introduce you to Scotty, our Australian Labradoodle. Scotchy. What did I say, Scotty?
Yeah.
Scotchy. And we just love him so much, and he's just such a sweet little boy. And he'll be making more and more appearances on my videos. So I wanted you to say hi to him and see him. And it's just such a loving experience. I wanted to, once in my life, have a dog and just see what that love is like. And also, it's been great for the kids, especially with the shutdown and no summer camps and maybe no school in the fall, or at least in person. So anyway, I'm going to give Scotchy back to my little one, and we'll get to some price charts. All right, bye, sweetie. Thank you. All right, guys, that's the important business, and we got the important business out of the way. So I want to turn my attention to Warren Buffett and this article in Bloomberg. So the article in Bloomberg came out on June 25th, and it says Buffett missed out on crisis, revealing Berkshire's big weakness. And you can go find this article on Bloomberg if you want. But basically what it says is Warren Buffett has underperformed, or Berkshire has underperformed the last 5 years. And that's actually just not true. He has not underperformed the last 5 years. He's actually underperformed the last 18 and a half years. And I think there's a bigger story behind it. I want to talk about this. And then after this, I want to talk about one more thing, what I see going on in the market. So first, let's start with just Berkshire, comparing him with just the index. So I want to jump over to the index here. And what you see on the screen here is two lines. You see a red line, which is Berkshire Hathaway, and you see a blue line, which is the S&P 500 with dividends reinvested. Now, this is the beginning of 2002. So literally, it's actually the very, very end of 2001. But for the last 18 and a half years, that red line, which is Berkshire, has underperformed every calendar year for 18 and a half years. Now, it's hard to see. Can you hold on a second? Hey, guys. So it's hard to see on here, but he actually has underperformed over this 18 and a half year time period. But let me just go ahead and do this, and let me just show you. This is the beginning of 2003, and the red line underperformed, which means Berkshire underperformed. And then you have 2004, he underperformed the S&P. I know I can keep this going. Hold on, guys. This is 2005 there, underperformed. 2006 underperformed. That's 2007, he underperformed. Again, this is the S&P 500. Then you got 2008, he underperformed, and the underperformance is getting worse. Then at the beginning of 2009, underperformance is getting even worse to the S&P 500. 2010 underperformed. Since 2011, underperformed. Since 2012, Berkshire underperformed. Since 2013, underperformed. Guys, stick with me here. 2014, still underperformed. 2015, since 2015, underperformed the S&P 500. Since 2016, he underperformed. Since 2017, he underperformed. And now it's going to actually be harder for me to get to. I want to get to, here we go. The scale on the bottom changed. This is since the beginning of 2018, and then let's get you to the beginning of 2019. And I think you have my point.
Okay.
Hold on, let me go back.
Hey.
Hold on a second. Kids clearly don't understand be quiet when I'm doing a podcast. Can you guys please be quiet? The joys of working from home. So let me go back to the beginning of 2019. So there, right there, underperformed. I mean, look at this. He's actually negative 12 to plus 28. And then we can just go to the beginning of 2020. and there's the beginning of 2020. So there's a couple things going on. One, he probably should have stopped managing Berkshire, 15 years ago, and maybe just been the chairman and let other people manage. What you're not seeing is today about 20% of his portfolio is Apple, and Apple has crushed almost everything. And the fact that 20% is Apple, that means that other 80% has really, really, really underperformed. And I think this is a case where people are fighting the last war, or they're kind of studying for the wrong test, right? People are still buying deep value, and people are still buying dividend, and both dividend stocks and value. I don't even have to say deep value. They've both underperformed the S&P 500 with dividends reinvested. And I really only see that happening more. And part of the reason is if you think about the demographic or the psychographic of someone who's buying a value fund, whether it's an ETF, mutual fund, or stock, or someone who's buying a dividend income stock, the ETF or fund, they're probably in their 50s, 60s, 70s, or 80s. And they're more risk averse. So when the market starts falling, they're more likely to sell their safe positions. And this is also why we're seeing utilities underperform too. So in the past, those were the safe places. But the people that are now buying them, baby boomers and the greatest generation, and even, I guess, Gen X, is Gen X in the 50s too now? I guess Gen Xers are in the 50s. But really people over the age of 50, they're getting less tolerant. They are less tolerant to price volatility. And guys, this is a mindset thing. This is why I often rail against big box advisors in the Pick of the Month newsletter, because people are getting hijacked by the word income or dividend or value or utility or staples. And they hear those words and they think, oh, that means I'm safe. That's a mindset, right? Because those words they're hijacking, and they're telling their mind that they're safe, but in fact, they're not as safe. And so everything is about mindset, psychology, behavior when it comes to investing, because all of our decisions and investments sit on top of how we behave, how we think, how we act, how we react. This is absolutely a mindset game. So so it wasn't just about Buffett, but it was also about just how we are getting, people don't really understand how much their own behavior, not the market, not the Fed, not interest rates, not the White House, not the upper house or the lower house, but their own way their brain is wired is actually hurting them. Okay, now staying on that same topic, I want to talk about what's going on today in the market, but also I saw this tweet from Michael Batnick, and I go onto Twitter about once a week just to see what's on there. But look at this. So shares of individual investors who sold all of their equity positions from basically February to May of this year. And this is amazing because if you look at 70 plus, over 30% of people over the age of 70 sold all their equity, meaning they went all to cash, right? Or maybe they had some bonds. Age 65 to 69, again, over 30. But even 60 to 64, over 25%. I mean, this is amazing. And then all ages, about 18% went to cash. And I think this is very dangerous. Again, this is also a mindset and a behavior. And I want to show you what I mean by this. Or I want to give you an example. So if you look at the price chart here, this is the S&P 500. And this is 2015, 2016, and 2017. So let me just so between these two blue lines, the market, let's go July to July. The market went sideways for a year. And these drops were about 13 or 14%, 13%. So didn't drop 15, didn't drop 20, just dropped down 13, went up, dropped again, went up, dropped again, broke below that, went up again. This scared people. But during this 1 year period, okay, this sidewaysness, not even a crash, this sidewaysness really scared people. And then something happened in November of 2016. It was the presidential election in the United States, and Trump won that. And you can see the market fell down into that. But on actually November 7th, it started moving higher. And I point this out because a lot of people went to cash when Trump was elected here. And this happened right after this sideways period. That was definitely a clean out. Right? People went to cash. Now, the sad part about that is this is the Trump election right here. And then the market went up from there. And the thing about going all cash, and I want to be really clear here, all cash, people who went all cash, that had to do with behavior and mindset and psychology and emotion and feelings, because one of the only reasons someone would have gone all cash is because they were scared. Scared is a feeling. And they didn't understand how their own language, other people's language, was affecting them. This is an absolute mindset game. Now, this correction today in 2020, I think it's two parts. It's one part 1987. And what I mean by that is it was so far, so fast, right? A 35% fall in 30 days had never happened before. Okay. So that was a very 1987. But the other thing I'm noticing is it's also a 2015, 2016 correction, because this not only scared people, but people are also, and this isn't even, there we go. We got to get the current there. People are now going all cash again, just like they did back to the Trump election. So we have this all cash behavior, like the 2015, 2016 / news and words and terms and not understanding it. And we have the 1987. And so what I want to leave you with is just how important it is to understand how your own words, how other people's words impact your behavior, impact your emotion, impact your feelings. And for a lot, this is happening underneath the surface, so you don't even see it happening, but it's absolutely the thing that's driving all feelings. And hey guys, if this is something that you're starting to recognize in yourself, then I want to make sure you know about my 2K for 10K course. It's my first do-it-yourself training course where I give all the tools, all the videos that I've given to my 500K mastermind course, which is my group training course, and when I used to do individual one-on-one training. It's all the same videos. It's all the same training. It's all the same tools, but it's more accessible because it's at a lower price. And we go into throughout the entire training how much words and how this mindset really works against you. And one of the things we do in the training is, one of the things I do with you is really rewire your brain so you get the shift, so you get the change that you want. So if you like these videos and you like what I've been talking about, whether you've been on a day or 10 days, I've been doing videos and blogs for over 2 decades. Go ahead and check out that. It's at fearlesswealth.com /2K for 10K. And thanks guys for being in my world. Let me know what you're interested in. Let me know what you want me to talk about. Please like this. Please share this. Please subscribe to the YouTube channel. I did get one comment that was interesting. I compared the S&P 500 against value, a value index. And the comment back was, or the way I heard it was, well, that's not fair because the value index has less stocks in it than the S&P 500. And I don't want to buy the junky stocks in the S&P 500. And the value stocks are only the best stocks. And I think that's not that sounds like someone else's language. Like, don't buy the average if you only want average, or you're only going to get the average return if you buy the index, which is the average. And the bottom line is those 500 stocks, the good, the bad, the ugly, are outperforming the selected set of stocks of value, right? So this to me is an example of where someone has been told that if you buy the S&P 500, and guys, I'm not advocating that that's your end goal, but if these 500 stocks, which include the bad ones or the junky ones, can still outperform a smaller group of stocks called value stocks, then that tells you so much at how much weaker value stocks are than even the S&P 500. So please send in your questions and your comments. You can leave them in the comments below. And at the top of comments in the read more is the link to the 2K for 10K. And that's really the promise of the do-it-yourself course. Invest $2,000 in this training course. And my promise, my guarantee is you'll get $10,000 of value, $10,000 of awesomeness, $10,000 of found savings and growth in your portfolio. And if you don't have that experience, I give you your money back. Thanks guys for being in my world. I appreciate it. Thank you for allowing me to record this with my 2 kids in the room, jumping on the table, wiggling my computer, talking in the background. This is what it's like in 2020. And I'm so thankful that I get to be home with them during the day. And now we've got this new puppy. So I'm super excited about that. Okay, guys, thanks so much. Take care of yourself. And I will see you on the next video. Okay, bye.